Hello, silver fans. This is T, and you're in the place to be for silver education, acquisition, and entertainment. Hey, in this video, I was privileged to interview a gentleman named Lior Gantz. Mr. Gantz is a brilliant businessman and editor of Wealth Research Group. Hey, this is not a sponsored video. Hey, just me and someone in the know talking about an upcoming market correction. Yes, a market correction is coming. He is predicting nearly $2,600 gold, but he has reason for optimism. So let's listen to see what Mr. Lior Gantz has to say. This is a little bit longer format than my normal videos, so sit back, relax, and enjoy. T.
Hey, Mr. Lior Gantz, coming at you from Israel, and to talk a little gold and silver and a couple other odds and ends. Mr. Gantz, thanks for joining me on my channel.
Yeah, thanks for having me.
And so, do you reside in Israel? I know you're a world traveler. You've been around the world. Tell me a little bit about yourself.
Yeah, I do reside in Israel, so don't hold it against me. But yeah, no, I love traveling, and it's very educational. I've been to 47 countries.
Wow.
So it's nice, it's good to see the world. It's good to see the world as an adult. It's important. It's important because you see first world, second world, third world. You see how a lot of people live, and it puts a lot of things in perspective. Also shows you a lot of opportunities, and it also, you see with your own eyes things that Western media reports on, etc. So yeah, definitely, and gives you a great perspective about gold, silver, and things that are not fiat currencies.
I can relate. I was traveling through the interior of Mexico years ago, and going from place to place, point A to point B, and I saw a whole part of the world that I had never imagined, people living in tough conditions, and that we here in the United States are not accustomed to seeing, and definitely very eye-opening, as you said. Yeah, well, let's talk about Market Meltdown 2022. I'm hearing from a lot of sources, a lot of my fellow YouTubers, but also a lot of mainstream media, the Bloombergs of the world, that, hey, we better brace ourselves for something big happening this fall. And so what can you tell me and my viewers about that?
I remember, distinctively, 3 major crashes in my lifetime. When I was just 13 myself, my father's business went under, and I started to work and save. And this is 1997. So by the time it's 1999, I'm already like 2 years babysitting and handing out flyers, painting decks, all that kind of stuff.
Yep.
And one of the children that I babysat, his father was he founded a startup company, and he sold it to a giant U.S. corporation and made a lot of money. And I was there in his house when his face was plastered all over CNN.
Wow.
But then a month later, the shares his company and his employees received from this giant American corporation went down by 50%.
Ouch.
Not that, well, it went down from $700 million that he made, that he cleared to 350. So don't worry about him. But,
Yeah.
but it's, I went through that. I saw that as a kid. And I started investing as a minor at age 16 right after. So that was like the first one. I went through 2008 in a big way. I was actually rafting in the Colorado River for 4 days while the Lehman weekend happened, and I didn't have cell service.
Oh.
So I'm waking, I'm going back to like cell service, driving with the minivan from the bank of the river to civilization, and my phone is like blasted with hundreds of text messages, and so that was different. because now I was 24 years old, and I was able to take action, like to capitalize on what's going on. And then you had the Euro crisis, if you remember, 2011, the pig countries. You had Brexit,
Yes.
and then you had December 2018, and then you had the March 2020. So what's different between the from 2009 onwards? All of these pigs, the Euro crisis, the Brexit, in 2018, and to an extent also March 2020, they're all big corrections inside of a major bull market. But the dot-com bubble was an end to a bull market. And I think what we're going through right now is the end of that 13-year bull market that started in 2009. And I define that as not the technical, 20% from top to bottom. That, to me, is not the main thing. The main thing is the investors' minds have changed between 2009 and and just up until January. Growth was the top priority for shareholders.
Right.
Revenues, if they were growing, you could lose money on the bottom line. Investors will still buy your stock, and the CEOs will, can still hire and expand and turn at a loss for years and years. And that's changed. CEOs are now getting very aggressive messages for top shareholders that they want to see a bottom line. It changes the workforce because you're not going to hire anymore. It changes your focus from growth, the margins, the profits, the bottom line. It's a different world. And I think that's what we're going through. And that's one thing. Okay.
Yeah, it's been nice seeing my 401k rise and rise and rise throughout that time period. But I had a feeling that couldn't last forever. And I think that's what you're talking about, is a shift in mindset that would cause that to change drastically.
Absolutely. That's it. We are changing drastically. Now, after the dot-com bubble, we changed, but it was a toxic environment because it changed to the securitization of mortgages, and that created a bubble. Hopefully now it's not. It's going to move to just a more healthy environment of profits or value. This period reminds me a lot of after the Great Depression, actually, 1932, when value investing became, the most important thing, Benjamin Graham and whatnot, because investors do not value growth. They're not willing to assign any premium to growth. They want to see now. They want to base you on now. So I think that is something that's changing. But with that said, everything that we're seeing this year is a reaction to the solution to the problem. The problem is inflation. The problem is a jobs market that's not equipped to handle what's going on. 11 million job openings and only 6 million applicants.
I can relate. I'm in charge of hiring where I'm at, and it's tough. It is tough.
Yeah, and it's not even that the 6 million are necessarily a fit for the 11 million jobs.
Exactly.
That's also a consideration. It's just like an addict, and the withdrawal period is very, very tough on the body, but it's a step in the right direction. So I see everything that's going on right now as a step in the right direction, because we're dealing with the biggest problem, which is very, very unsustainable CPI numbers, which we know are probably 50 to 60% below real inflation. So, so this is key, and not to be too optimistic, but also think about this. We just went through two of the worst years for businesses, for individuals, like mental issues, quarantines, problems. If you told all the business people in the world 2 years ago, hey, let's do a test. Let's see how you handle 1, 2, 3, 4. Like, nobody would opt into this experiment. Sure. It's been a very rough time, and we weathered it. So I'm actually very optimistic. It's just that when you go through the jungle with a machete, I mean, you need to cut through these, crazy thick woods to
Mm-hmm.
get to the highway, and that's
Mm-hmm.
how I feel like we are right now.
Okay.
So I don't see as many billionaires, Ray Dalio and Tudor Jones or Jeff Gunn, like people that I have a lot of respect for, but their minds have turned rigid and bearish in general. They're just bearish as a state of mind. So Ray Dalio is talking about 15 years until we see the all-time highs again. So to me, I don't look at it that way.
Mm-hmm.
I don't look at the economy as an economist. I look at how can I own more of America all the time? How can I buy more quality companies,
Mm-hmm.
companies that are very hard to compete with, and just stay the course?
Mm-hmm.
That's with my stocks portfolio. But
Mm-hmm.
I don't know if you've seen any other interview that I did, but one thing that I I tell every interview is my physical gold and physical silver allocation. What I did was I took 2 years, or basically 24 months
Mm-hmm.
worth of my living expenses. So I took my monthly burn rate as a family unit and
Mm-hmm.
multiplied it by 24, and I converted that fiat currency into gold and silver. So you can imagine, like, do your own math for your own life, how much you
Mm-hmm.
spend a given month times 24 and convert that. And I feel very comfortable with that amount. Um,
Yeah, very few
so
people would go that far, but I think that's a wise thing to do.
absolutely. And you asked me about my 2022 outlook and
Mhm.
just my general thesis.
Mhm.
I put together a special report for your viewers and listeners about my 2022 outlook. We pulled from various sources. There are companies we pay thousands of dollars to create this research and graphs and charts that are exclusive and proprietary. So if you can access that for free if you want to at
Okay.
wealthresearchgroup.com/2022, or basically 2022. That's
Okay.
my economic outlook for the entire year. And if you want to see my 11 major catalysts on why I think gold is going to $2,582 an ounce, you go to wealthresearchgroup.com/11, 11, or type in 11, and you can download those two. Those are gold oriented reports, or just macroeconomic reports, I would say.
Sounds good. Those will be in my video description for my viewers. How about silver? What are your thoughts on silver?
Silver, much more than gold, tracks inversely, tracks or is inversely correlated with the DXY. The DXY index being the dollar versus major fiat currencies. And right now, the dollar is at a 20-year high.
Right.
It reminds me a lot of right after 9/11,
Mhm.
when the dollar was very strong because of everybody's fearing on a institutional level, on a Wall Street level. And when you sell, when Wall Street sells down Apple 5% one day, they settle in cash, and that cash is dollars. So there's a lot of demand for dollars when you have a year like this where it started as the worst year for stocks since 1939 and the worst year for bonds since 1920. So there's a
Wow.
lot of settlements in dollars, and the DXY therefore is in high demand, just like it was in March 2020 when everyone was selling stocks and bonds. So once this flips, silver has a very good chance. But right now, silver is getting decimated. Plus, a lot of recession fears are putting silver down. But I think once the summer fades and a
Mhm.
lot of these fears about recession go away, because I don't think that there's a recession coming in the United States. I think that there could be a recession in Europe that
Okay.
drags China into it, and then eventually a slowdown can come to America, but not for a year or two.
Okay.
Um, the American economy is not strong like it was with all these stimulus checks, obviously, but it's growing. The
Hmm.
big picture for the United States, the demographics are amazing. unlike Europe,
Mhm.
where they don't have children.
Mhm.
The countries are shrinking.
Wow.
Italy, France, Germany, these are shrinking demographics. Uh, Japan is a country where more adult diapers are sold than baby diapers.
Okay.
They're going towards 70 million people. From think about that.
Yeah.
That's the second largest economy in the world.
Wow.
China is in the demographic problem, whilst the U.S. The demographics look amazing. People have postponed marriage for 2 years, so now there's going to be a lot of
Mhm.
marriages, family formations. These people need homes. These years between your 30s and 40s are your peak earning years, your peak spending years. It looks very good. It looks a lot like the early 80s
Okay.
in that regard. So
Well, that's
uh,
very
uh,
promising, and it's good to
very
hear that from
promising.
someone with your kind of perspective.
There's a lot of research done by a person that the USSR leaders had basically silenced and perhaps even killed. It was a famous economist
Mhm.
named Kondratiev, and his famous Kondratiev waves are basically waves based on demographics, which he put together, many decades ago. And right now, we're in one of the best Kondratiev waves for the United States for the next 8 years, 7 years here
Oh,
until
wow.
2029.
Mhm.
A very good period, and
Mhm.
I'll explain to you why. The demographic group between the 35 to 49 year olds
Mhm.
far exceed the 18 to 34 year olds. Now, the 18 to 34 year olds are, you know, they have less money, more debt, less expenses. In the 35 to 49 year olds, those spend a lot. They need new cars, new homes, vacations,
Mhm.
more money into equities. By the time this decade ends, I would be surprised if the S&P 500 is over 10,000 points. We're in a very good period for the United States,
Mhm.
and what you're going through now is sort of the preparation to make that happen. I equate this almost to like a Formula One race.
Mhm.
Um, when you have a tire problem or anything else, you need to go back to the pits. You
Mhm.
change tires, you change this, you change that. That's one thing, because that takes time. You go in there and whatnot.
Mhm.
But sometimes there's nothing wrong with your car whatsoever.
Mhm.
Your fuel's good, your tires are good, everything's kicking, and then
Mhm.
there's a red flag or a yellow flag because of somebody else.
Uh-huh.
But your car is primed, it's ready. But you're on the communication saying, "Hey, this safety car better move faster. My tires are getting cold," because you feel really ready, but you have to wait for that green light and for the safety car to move away. That's
Mhm.
how I feel we are right now. We're in a very good position. We just need that safety car to move away and say, "Hey, we inflation is a problem, but we're handling it. I think we're good." The problem that the Federal Reserve is facing is, for the first time in many, many years, there's um, there's a lack of innovation and creativity from Washington, from the administration, and I think that they're lagging. So the Fed, what it can do, it can impact your behavior when it comes to your demand for things, right? When they raise interest rates and crash the NASDAQ by 30%, then somebody that had $1 million for retirement now has $700,000. He
Mhm.
will either consume less or stay in his job for a couple more years.
Mhm.
So you change his behavior. Mortgages are going up, so people are reluctant to originate new mortgages because the payment are rising. But at the same time, rents are high, so it's not really a solution, right?
Mhm.
More jobs, it's more everything. So I think the government has a lot to do with the supply side, and there's a diminishing return to what the Fed can do on the demand side. You don't want to destroy uh, America's businesses in order
Mhm.
to stop inflation. You don't want to create a recession in order to stop inflation. That's stupid.
Yeah.
um, you want to create a balance between supply and demand. And I think the government is lacking there. But at the second half of the year, with the midterms coming, I think there's going to be way more promises and way more action. And that's why I think like the second half will be much better than the first half. So that's my position on that.
Well, it's good that you have the perspective. Sometimes, those of us in the silver stacking community, my viewers, we have a hard time seeing the forest through the trees. But again, you've got that perspective, and you've got good reason to be optimistic. And that's a fresh look. I appreciate that.
You also can look at what's called inflationary expectations. The University of Michigan does a lot of surveys, the biggest surveys in America for consumer confidence and consumer expectations, etc. Inflationary expectations have peaked. So we're not like the 70s where people think, no, it's going to be more expensive next year. No, they have peaked. People understand that this happened because of 1, 2, 3, 4, 5, and we're dealing with it. Also, consumer confidence has not cratered. The consumer doesn't feel like the world is ending and whatnot. There are concerns about recession. There are concerns about a slowdown. It's not like it's not out there. You can look at Google Trends. The word recession is very trending right now, and there are other words that are trending. But I have yet to see a big recession that everyone's talking about before it happens, because talking about it is it's part of the cure. Usually recessions come when people think it's a boom time. And everyone tells you not to buy real estate. When everybody tells you not to buy real estate, it doesn't look like a bubble to me, right? I like Larry Fink. Larry Fink is the founder of BlackRock, world's largest asset manager, and he always says whatever people are talking about is not where the problem is. So, you know what I mean? Like, who would have thought about Russia?
Right.
Even though, since September, they've moved troops and whatnot, but nobody talked about it. And so, boom. Exactly. And I think, the next thing that will disrupt markets is not inflation. It's not recession. It's something that that's brewing, but we're not talking about. But that is always the case. That's always the case. There's always, if you put one of these pyramid bears on CNBC to talk about America and America is past its prime, it's endless. I've seen it literally I'm 38 in 2 months, and I started investing when I was 16. I've seen it every year for 22 years. There's always a problem, and CEOs always overcome the problem. There are always companies growing faster than GDP, faster than inflation-adjusted GDP. There are always companies that are innovating, that are doing what they need to do. And luckily for you, they're public, so you can own a piece of them. So I think that, if you keep that in mind, that there will always be problems. And in fact, I'd like to recommend that everyone listening to this buy the book Triumph of the Optimists, one of Warren Buffett's favorite books. And it just talks about the 20th century, 2 world wars, influenzas, flus, oil shocks. It names everything we went through in the 20th century. And yet it also shows how much wealth was created in the stock market. So that's one thing. And also just keep in mind that unless you're just about to retire, this shouldn't concern you. All these declines in the market should just be more opportunities to buy more equities.
Yeah, I've got about 15
it,
years or so, and I'm considering it as buying opportunities if things go down a little bit. I believe in my heart that they will go back up. It's just a matter of time.
Yeah, inflation adjusted and dividend adjusted, there has never been a time that you'd buy equities and you'd be down on the major indices 13 years later. You can pick any random year, including 1929, 1932, 1930. It doesn't matter. You don't bet against the world for a very long time. And that's why, with 2 years worth of gold and silver in my, in my duffel bag, so to speak, I feel like that's good. That's good for these cases where you have a dysfunctional administration or a problem, or the Chinese leadership decide to move battleships into Taiwan or something crazy.
Mm-hmm.
But for the most part, have your wealth in equities and in real estate, and that's just the way to go. And obviously, focus on your career as the primary driver in your life. I would say definitely as you move towards retirement, less market risk, more fixed income, more
Right.
real estate, more other investment types.
Well, I certainly appreciate the time, and I'm going to be checking out those sites that you mentioned. And it's just about the time of year when I grab myself a decent book and take some time and enjoy it over the summer. But I
Beautiful.
just wanted to wrap up by thanking you for giving me and my viewers a different perspective than we're used to seeing, over and over.
Thank you very much.
Absolutely. You have a good one.
Thank you, sir.